G'day everyone, welcome back to another episode of Spark Your Fire. It's your host David Shih here, and as always, I've got the pleasure of my best mate, one of my best colleague in here to talk about property, John Comino. How are you doing?
Hi there, David. I'm very well. Good to see you again.
Likewise, mate. Likewise. We are so close to Easter now. I think a lot of people have started taking Easter breaks, so
Right.
it'll be interesting to see what property market does this week, actually, given the fact that it's a long weekend for pretty much all of Australia, and whether the numbers will still stand very, very strong, I think. But anyway, listeners, we hope you're all having a wonderful week and leading up to Easter. Now, the big topics this time round, I reckon, we literally just missed the margin last time before the banking crises that's actually unfolded across the globe. So I thought let's touch on that today, given the fact that, John, you've obviously got very good insights around what's happening with the Silicon Valley Bank and the Signature Bank, as well as the Credit Suisse, having all these crises around the world. What does it mean? I guess I want to look at it from a perspective that, the US system is obviously very different to us here in Australia. So think of it like the way that the banks run things there is quite different to us. Okay, so I want to kind of tackle it to understand how come these banks fail, which I think you obviously looked into it, why these banks fail, what can we learn from it, and whether Australian banking system is going to be potentially at a jeopardy as well. Should we be cautious at all, essentially? So that's tackled from two angles, I think.
Where to start? So the crisis is probably the wrong word. They had a major disruption in the US banking system, and it was really focused on those regional banks. Now, in Australia, regional banks sounds like a weird thing. You've got all these little banks around, but actually, if you think of but it's normal to have small local banks, because that's the best way for a lender to understand a local property market, let's say, or local businesses. So you don't want a national bank based in Washington or New York lending to someone in Tennessee. You want a local bank. So that's why local banks emerge, big country, and so on. And if you think of Europe's the same. We don't think of them as regional banks, but Europe's got the National Bank of Greece and BNP Paribas in Paris. You've got all these local banks. They're regional banks too, in a sense, but they're country oriented banks. So the banks a couple of banks went bust. Actually, you're right. It was the evening we did our last podcast. But we had nothing to do with it, people. I promise. So Silicon Valley Bank was the first one that went. And that was the second biggest bank failure in US history. Prior to collapsing, Silicon Valley Bank was the 16th biggest bank in the US. So material. And then subsequently, a Signature Bank failed, which was a smaller bank, but nonetheless significant. So why? I think there are two questions, right? Why did it fail, and what does it mean for us? Yeah. Okay, so a couple of two main reasons why Silicon Valley Bank failed. Essentially, depositors were taking their money out, and Signature Bank had to cover it. But if you think about who the clients were Silicon Valley tech startups.
Yep.
They were tech startups, but they also had big clients like RockU, eBay. So they had a lot of big depositors in there as well. And when they started pulling their money out to pay rent or to pay salaries and so on, Silicon Valley Bank had to cover the liquidity gap. So they had to cover. So these weren't debts going bad. It wasn't that they lent to Silicon Valley companies and it went bad. It was literally that deposits were being taken out and they had to cover it. Now, the assets that Silicon Valley Bank had to cover the deposits that were going out the door were long maturity treasury bonds. So when interest rates were really low, Silicon Valley Bank bought all these assets to liquefy their bank. But as interest rates were being put up by the Fed very, very quickly, the value of those bonds went down. And when they had to replenish their deposits, they would sell these bonds, but they would sell them for about 80% of what they bought them at. So they incurred these massive losses trying to cover the deposits that were being lost. So it's partly, but there's also some other nuances. Apparently, they spent 8 to 9 months without a risk officer. So the risk officer left, and they didn't replace that person. Also, Silicon Valley Bank was involved in politics, the politics of the day, and they may not have been particularly au fait with banking risks. So it was a lot of management problems there as well. They weren't a great management team. But essentially, if you had to boil down what the problem was, it was a duration mismatch. They had long range bonds securing their deposits to fund a short-term cash flight that was leaving from deposits, and there was a mismatch, and so they went bust. That's essentially what happened. Now, just to sort of put a ribbon on this, and one of the things that's not being spoken about a lot with Silicon Valley Bank is that while we know that they had a big exposure to tech startups, the other thing that's not being talked about is they were banking about 70% of green energy projects. So one of the jokes is you can get anything banked if you say, or get government funding if you say it's climate change related. So you could have diabetes and climate change, and you'll get a grant or a loan. So these guys were heavily involved in green startups and green energy, like battery projects and those sorts of things. So there could be a knock-on effect to that sort of movement, to the economic viability of a lot of those projects. But generally speaking, it's good when unviable projects get eliminated, and that's the creative destruction of the market.
Yeah. Okay.
So there is a little bit of that green energy component that's not really being discussed. But to answer your final question, what does it mean for us? I mean, very little. I think in Australia, I think most of us bank with the big four. One thing I didn't mention actually is that the FDIC, the insurer for deposits, bailed out the depositors, but not the investors. So all the depositors were whole. That would happen in Australia. I just think that there's such little in common with the US banking system in Australia. We have a highly centralized banking system, highly regulated, highly protected, which is why we don't do a lot of tech innovation in Australia. We lend to real estate, and that's about it. But it also means that our banking system is a lot safer. So I don't see there being a problem. That said, I don't think we're out of the woods in terms of the banking problems, because I mentioned before that duration risk, the impact of interest rates increasing as quickly as they have, it's gonna impact a lot of companies. There's a lot of speculation. I probably shouldn't name names, but there's a lot of speculation that the next banks that could be in trouble are Deutsche Bank and maybe even HSBC. And Deutsche Bank has been spoken about for at least 10 years about their derivative position being too big. But these things can, when the tide goes out, so you never know. But it could still resonate. I mean, I remember back in 2008, before Lehman went bust, there was Northern Rock, which was an obscure bank in north of England, and then it sort of went up the food chain to Lehman Brothers and Bear Stearns. So you never know.
So you do think that this is potentially only the start of the collapse of more potential banks around the world. If the central banks around the world continue their current trajectory of rising interest rates to battle against inflation, then this is going to be an ongoing problem.
Yeah, I think we're looking at. I think it will take years, but I think that this is the beginning of a big banking consolidation in the US. So you've got lots and lots of banks, and I think that it's possible that that the number of those banks will decrease. Now, that won't affect Australians necessarily, but it's not a good thing. You want a big competitive banking system. Now, the conspiracy theory is that they want to, I don't know if we want to go there, but sort of centralized banking a little bit to roll out a digital currency. Now that may or may not be true, but there's murmurings that that this is to reduce the complexity in the banking system, the number of participants, so that a central bank digital currency can then be rolled out to fewer banks. But who knows?
The CDBC that's kind of been talked about for a while now, isn't it? Part of the overall plan in that sense.
That's right. And who knows?
The funny thing that I guess the interesting thing that baffled me was, obviously straight away after these SVB and Signature Bank has gone into liquidation, the Fed jumped out straight away and said, we will guarantee those depositors that your money is going to be safe. Now, how are they going to get their money though? They can't print more at this point. I mean, we are trying to actually battle against inflation. So printing more money is going to go against, right? Because we're actually trying to tighten credit at the moment. So I don't know, with all the balance sheet that's already in such a big red, with red of C in US Fed, how are they going to be able to guarantee these from by liquidity? Are they going to print more, do you reckon, John? Or some other...
The money supply has already done a U-turn and started going up. Yeah. They've done a few things. You're right. They're guaranteeing deposits. The FDIC does that, and then they cross their fingers that people don't take their deposits out. So, but they also one of the other things they did more quietly was they said to the banks, including the company that bought the Signature Bank assets, is that we will honor the coupon value of the bond. So if you bought it for $100, we'll, even though it's only worth $80, we will give you the $100 back. That's also how they liquefied the system.
Okay, cool. All right, that's good. Thanks for the summary, John. I think you obviously, as always, express it very elegantly and it's simple even for me to understand. So I'm sure that helps our listeners to understand as well about what that means for us. Funny enough, though, I think Fed still increased their interest rate by 0.25% last month. I would have thought that, having seen these banks starting to collapse, they would consider maybe a pause, but they didn't.
Yeah, they increased interest rates by 25 basis points to retain their credibility. I mean, the rhetoric has been that they're inflation busters and they're not going to stop until they put the beast back in the jar and all that sort of stuff. And so, they increased interest rates because they said they would, and because what they said if they didn't raise rates would have no credibility. I think the market's 50-50 on whether there'll be more interest rate increases. I think the bond market, which is, they always say that the stock market lies, the bond market never lies. So if you want to make predictions, you got to look at the bond market. And the bond market's suggesting there might be interest rate cuts within 3 months.
Yeah, wow. Okay.
3 months, which is not what anyone is talking about, but that's what the markets are starting to suggest. So
the cyclical nature.
We always said that they'd raise rates until something broke, and rates had never gone up as quickly as they had. It was almost my ears were burning watching the interest rate increases. But of course, there's too much debt in the system to increase rates that quickly. So it's amazing how resilient the economy's been, the property market, and so on. But we'll wait and see.
Yeah. Okay, cool. All right. But I guess, just following on that, even though Fed has increased, but RBA has decided to hold still this month in April. So that's kind of a bit of a relief for Australian mortgages, especially with everyone just starting to see and started to feel the effect of the 10 consecutive rate rises. But I guess a bit like what you're saying yet, we're not completely out of the woods as well. A lot of people were optimistic about, are we at the top of the rate cycle at the moment? I mean, it's like you said, they continue to raise rates until something broke, and we're seeing something that's kind of broke in the US or the Europe banking system. Luckily, Australia banking system is a lot more robust in that instance. But, I think RBA has taken a cautious approach at the moment, in the sense that they wanted to pause this month in order to be able to see and gather more data and decide what they're going to do next month. So I think there's a couple of things from the minutes which was kind of, sorry, statement I should say, was kind of interesting. The minutes hasn't been released, but the statement has been released straight away. So their priority is still returning inflation to target. Okay, that's still the number one priority. And they are still seeking to return inflation to 2 to 3% target range while keeping the economy on an even keel. But the path to achieving a soft landing remains a narrow one. So at the moment, we are still on a very tricky path in terms of, because, the higher the interest rate rises, the more likelihood that it's going to break the economy, right? But so how much is enough for us to be able to just get out of the woods without having to break the economy, without having people losing their jobs, and without property market completely crashing? Basically, that's what they're all trying to juggle at the moment, is my understanding. Now, the board expects some further tightening of monetary policy may well be needed to ensure that inflation returns to target. Okay, so it's a pause. I think the key here is it's a pause. It may not necessarily be the top. Okay, although a lot of people were kind of speculating, look, it's enough, don't do any more. People haven't feel the hurt yet, and they will. But I guess the decision to hold interest rates steady this month provides the board with more time to assess the state of the economy and the outlook in an environment of considerable uncertainty, including what we just talked about from the global banking perspective. In assessing when and how much further interest rates need to increase, the board will be paying close attention to developments in the global economy, trends in the housing spending, and the outlook for inflation and the labor market. Okay, so household spending, basically, and the inflation trend, which I think last month it's now down to 6.8%, so which is good. It's below 7%. So I think maybe it's a bit too early for us to tell, because we're just about to go into Easter, and I reckon people will be spending for traveling again. So hopefully the ugly head's not going to re-up again next month. But if the inflation figure doesn't continue to go down, then unfortunately there might be a few more rate rises that's still required in order to get the to get to where they want it to be. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that. So that kind of concludes in terms of their stance. It's a pause at the moment. We need a bit more data. We want to basically wait and see to see what's happening. Funny enough, though, there's a lot of uncertainty in that statement, John. I feel there's a lot of uncertainty. It could go either way. It really comes down to the data that's to be released in the next couple of months to see whether the peak of inflation was really happening in December and whether we have actually gone through, or there could be a second spike potentially on the inflation data. And this, I think, funny enough, reminded me of the SQM research published last year in regards to a few different scenarios. I'm not sure whether you remember, right? There was a worst case scenario where we thought that we got the inflation under control, but it didn't. And then the interest rate had to continue to go up in order to be able to combat that. So hopefully that we're not moving into that path, because I think it's going to be way above 4% from memory, and then property market is going to take a huge hit on that basis. So it is a narrow path in summary at the moment. RBA is trying to tread it carefully by, I guess, balancing everyone's needs to a degree. And they do acknowledge that a lot of households have not fully felt the increases as yet. But there will be more people that will feel that as we progress throughout 2023. So
yeah, I mean, a lot of the scholarship on the second phase of inflation, where it's sort of you think you're on top of it and it comes back. That's based on what happened in the 70s and 80s. There were all these false starts. People, they'd hike rates, they'd kill inflation temporarily, and Volcker was accused of not raising rates quickly enough, and then dropping them too soon. All those sorts of things. So back then, inflation came back just as they thought they were on top of it, and I think that's the reason why, if it rhymes, it might look something like that. I always look back at those periods of time and just say there is just so much more debt now. It's hard to see the parallels. Besides, we're in a general stagflation. I agree with that. It's hard to see the patterns playing out the same way.
Yeah, it's crazy. It's crazy.
There's one other curveball when we talk about interest rates, and I don't know anyone who's talking about this, so it could be my own paranoia.
Sure.
But I really do think that the rate rises are loosely or directly or indirectly related to the Ukraine war. We know that sort of when Russia invaded Ukraine, we sort of locked Russia out of the SWIFT system and froze their US dollar treasury holdings and all these sorts of things. And I can't prove it. I just think that part of the reason rates have had to go up is as part of a financial tool in the arsenal in the Ukraine war. So, we know that the US dollar has been weaponized in some ways, and a stronger US dollar is a point of strength for Western countries, and we are part of that USD orbit. So I feel that as long as there's a hot war in Ukraine, interest rates will stay high in order to sort of keep a lid on oil prices, let's say, or other commodity prices. Yeah, we'll see.
Okay. Interesting. All right. Okay. Well, so that's the summary with the RBA cash rate this month, which is good. Gives us everyone a bit of time for reprieve to get their feet stable. Okay, a couple other topics that we want to just probably touch on briefly. So one of the biggest construction company in Melbourne, Porter Davies, has gone into liquidation earlier this month. So that's left the building industry. Well, we all know that. I think a lot of construction companies are struggling, but having a sizable company like Porter Davies actually gone into liquidation is definitely a huge hit to the already suffering construction industry at the moment. So they are actively looking for, I think the liquidators are actively looking for builders who's going to be able to take over the unfinished projects. But I guess the key lessons that I got out of it is actually some people will actually lose their deposit in this scenario. It's an unfortunate fact, but the way I read it is the insurance is actually not kicked in until the time when the planning permit comes in. So I think what Porter Davies may have done is they haven't actually put in the relevant insurances in place until planning permits have actually been received before they start commencing the constructions and plan for that. So anytime between from the time you sign a contract up until the time planning permits has actually come through, which might be a couple months, till maybe even 6 months or even 12 months, depending on what the backlog is like, right? At that point in time, the consumer may not have been protected in that instance. So if you are engaging a builder at the moment in the current environment, it's probably worthwhile for you to actually touch base with your builder. If you have already signed a contract, make sure you got the appropriate insurances in place. Follow up with the builder to see, have I got something in case if the builder actually goes bust tomorrow, am I going to be able to get my deposit back? Because, we're not talking about small money here. You could be easily losing 5-6 digits, depending on how much you put in. So that's probably the moral of the lesson I learned out of the Porter Davies. There's not other things. I mean, you can't control how a construction company operates, unfortunately, in this instance. But, the best is to be able to protect yourself as much as you can. Any other thoughts on that, John? Any other things that you could add?
No, I think you summarized it great. I mean, we came back. It's duration mismatch again, right? So the construction company commits to a price, and inflation burns their profit in the meantime. So they commit to a price that's fixed, but their input prices increase. So it's that duration mismatch, which you summarized brilliantly. So that's a business model that's hurting builders at the moment.
Yeah. Okay. All right. Cool. CoreLogic data, one of our favorite stuff to talk about. And we spoke about how quickly things are changing, and it's amazing to see how quickly the numbers are changing at the moment as well. Just before we came on air, John and I kind of had a bit of a yarn to say, we used to see properties kind of being very stable, but now it fluctuates so quickly. It started to match the share trend or even the Bitcoin trend in terms of, having a huge spike here and there in such a short period of time. But on the positive news, I guess, for those Sydney siders is that Sydney has had a really positive month this month, and we are talking about a 1.4% month increase. And that's, if we annualize that, that's a double-digit figure.
Yeah.
That is a double-digit figure. So it's amazing how quickly they turn, right? I think last month it was like 0.2 or 0.3%. And now, it's changing to 1.4% already. And if I break it down to houses and units, houses was doing 1.5%. So it was increasing at 1.5% just last month. Units has also started to go up at 1% at this point in time. So it's firing in all directions, John, at the moment, the way I read it. And, for the first time as well, it's the national figure is not a negative figure. It's now a positive 0.6% increase across the dwellings. So are we out of woods yet? Are we going to start to see a positive? Have we reached the bottom, and have we passed the bottom, John?
Without my crystal ball here. So yeah, look, it looks like we bottomed in November. That's what it certainly felt like, and that's what the data suggests as well. Yeah, we did 0.5% last month and 1.4% in Sydney this month. So Sydney's the best performing capital, and it was looking cheap at the end of last year. I follow the CoreLogic daily index, which comes out every day, obviously.
Yeah.
And April's going to be even stronger than March at this rate. So We'll see.
Okay.
I feel like there's a lot of cash on the sidelines. I don't think that there was enough burnt fingers from the 2022 price crash. So I just think that there was just money on the sidelines. I just don't think that many people got burnt, and all that money is getting deployed now in what looks like the bottom of the market. We do our gold to real estate ratio on those videos, and no matter what the interest rate is, when something's cheap enough, it's cheap enough. And so that seems to be what's happening. And the rental yields are making Sydney very compelling, because what's even tighter than the sales market is the rental market. It's just the rental market is really, really hot.
Yeah, and that's driven by basically no supply at all, isn't it? And we're still, with construction companies going bust, like Porter Davis,
yes,
it's just going to make it even harder on an already backlogged shortage of construction dwellings, or new construction dwellings that's about to hit. So I think the rental shortage is going to continue in the next couple of years. Unfortunately, there's no way that I can see they've got a solution in the short to medium term. Which, funny enough, I think I actually posted something about it yesterday as well. The way that we spoke about how easy it was to get credit maybe a couple of years back, back in about 2015, 2014, before APRA really put the handbrakes up. And at that point in time, there were a lot of people, investors, who were able to purchase maybe 4 or 5 properties in a year. Those days are gone, basically. And it's so difficult now even just to get, say, 2 properties. So perhaps in the short term, and it's just my opinion, a short-term way to be able to counter against this is they need to ease lending. So that way investors can come back into the market, because that's the quickest solution. Rather than having to build more, if you're able to get investors to jump into the market and provide enough incentives, investors will come back into the market. They will provide dwelling for renters, which would then make more properties available for rent, which would hopefully be able to reduce that rental crisis a bit. I reckon that's probably the most effective solution in the short term.
I totally agree. I think that, this is when regulation backfires, and to give a bit of a nod to the free market, when before APRA stepped in to regulate lending, because now lending is highly dependent on income. In the old days, you could buy a property, you could get some equity, and you could divert the equity. And as long as you could sell the property, the bank didn't mind. You didn't have to have this whopping big income, because serviceability wasn't necessarily the main game in town. Now everything's about serviceability. So what does that mean? High income earners, and only high income earners, can buy properties. So that's real estate, it has become the realm of the very wealthy and the very high income earners. In the old days, it was a very bottom up, mum and dad type of thing. But now only high income earners can get loans, and that's because of the hyper regulation. I'd much rather we go back to a looser system, not completely, no cowboys, but something a bit looser, that it's not all about serviceability. And I think that would sort itself out. But
yeah, Yeah. So we'll see what the government do there. But yeah, I think it's obviously a very, very important issue that they're trying to tackle in terms of housing affordability, in terms of the rental crisis moving forward. So let's see what can be done. Actually, on that basis as well, we've had our New South Wales state election, and Labor has took over New South Wales as well. I think I saw the Australia map now, except for Tasmania. Everywhere else is red. So well done to the Labor team. Now, what does it mean for the property for New South Wales in that sense? So I think there's a couple of quick changes I'll just go through very quickly for our listeners. So the biggest change is on the first home buyers front. The Liberal government has introduced potentially what they call the first home choice. So you can either choose to pay stamp duty upfront, or you can choose to pay annual tax for the life of you owning the property. So the idea was to basically be able to save your stamp duty money and be able to put that in as part of a deposit to help you purchase the property. Now, Labor has confirmed that they're going to scrap that. Okay, so unfortunately, this change didn't come along. I think it only kicked in around January, and it may only go up to 30th of June. So, it will probably get scrapped from 1st of July this year. So for those people who want to take advantage of this, you probably need to act quick at the moment. Okay, I believe it should get acknowledged and will probably get grandfathered moving forward, or still get, but 1st of July onwards, there won't be an option to be able to pay annual tax, and the Min's government is probably going to push towards paying stamp duty upfront again, because it is an important source for the government. Now, on the positive side, though, they are going to increase the stamp duty exemption from $650,000 to $800,000. Okay, so in other words, beforehand, you don't have to pay stamp duty up to $650. Now you don't have to pay stamp duty up to $800K, and that's probably going to kick in on the 1st of July as well. From $800K to $1 million, you will get discounted stamp duty. Okay, so they effectively increased the threshold for the stamp duty exemption and the discount to cater, I reckon, mostly for the New South Wales and Sydney properties because of the higher purchase price as such. But the question remains, can people still afford to borrow that much is going to be the question, right? Like, if you continue to, at the moment, the lending is already tight. So, we're talking about maybe 5 times now, whereas beforehand, people can easily get up to 6 times DTI, or even close to 7 times if required. Now it's even very difficult to get 5 times. So if you're on a 100K income, your borrowing capacity might only be capped around $500,000. So unless you have a big deposit, then you're still getting nowhere near the 800K or the $1 million. So I'm not too sure, personal opinion again, not too sure whether this is really going to help or not. But anyway, that's where we stand. John, anything you want to touch on there as well?
No, only to say, I mean, not in terms of property. I think she'll be steady as she goes. I don't think there's any major disruptions. The first home buyer grant changes, are a big deal. I mean, I think that people like the choice, but because it had only been introduced so briefly, I don't think it'll have a big impact removing it. It wasn't in for long enough to be a structural part of our market. I mean, I like that they've banned mobile phones from the classroom. That's the biggest takeaway for me. And overall, I mean, all the infrastructure projects that were good for Sydney, they're all in place. So I don't think that will, city metros and those sorts of things. And my broad philosophy on these things is that changes in government are healthy as long as it doesn't happen Italian style every year. I'm I think these things are healthy. So it's I wish them luck.
I heard they're scraping 2 of the 4 proposed metro lines at the moment as well. Yeah,
I hadn't heard that.
Yeah. So maybe look into that. I think the north line from Tallawong to airport is still going to remain, and the south to the new airport is going to remain. But the Parramatta or the Westmead to the airport is in question now. Okay. So is Bankstown to the new airport is also in question. So yeah, so I don't know what Labor government's going to do there, but maybe because of funding issues or different priorities, or maybe they're going to put those on hold. So who knows? So
I mean, the City Metro comes online in 2024. They're going to get a lot of kudos for that, and then you've got the Metro West, I think, a couple of years after that. So that they'll be in power for the ribbon cutting of a lot of these really important infrastructure programs. So it'll be good to see how Sydney changes.
Yeah, indeed. Okay, last but not least, clearance rates. Do you want to touch on the clearance rates for Sydney, John?
Sure. So the clearance rates, anytime they're above 70, that's a good thing. And last weekend they were 74% in Sydney. Yeah, really good. Same as Melbourne. Melbourne was 74%. Brisbane was 76%. Adelaide was 80%. I mean, I still see Adelaide as overvalued, but they're selling like hotcakes, and the rental market is the tightest in the country. So they're doing well. It's Canberra. It's down to 57%, but Canberra's not really an auction market. And in terms of like where the markets are hottest, so really it's segments, not anything else. So it's really the upper north, the lower North Shore, the eastern suburbs. Inner west is really hot at the moment. I'm hearing records in Concord and places like that doing really well.
Wow. Northern Beaches.
Northern Beaches is really back as well. They're doing really well. In last weekend, actually, the highest clearance rates were in Canterbury, Bankstown, Northwest, and the Northern Beaches. And interestingly, units had a slightly higher clearance rate than houses. But generally speaking, except for Perth and Sydney, units are outperforming houses across the country, except for Perth and Sydney. Yeah. So clearance, look, the market's really strong at the moment. So we'll see how much gas it has, but really strong.
And these are the figures before RBA announced this month's pause as well. So I don't know what's really going to happen. Given the fact that this is a long weekend, so the numbers may not be as stunning. Most people are going to be away, but next week onwards will be interesting. So we'll see.
Yeah. And look, stock comes on after Easter as well. So at the moment, it's pretty scarce, but stock comes on after Easter. So it'll be interesting to see what happens to supply.
I wonder if the supply continues this way, then the price is going to continue to go up because of the fact that shortage of supply. But if the confidence level started to restore from sellers' perspective, which means there'll be more sellers putting their properties onto the market, does that mean we're going to see more of a flat trend moving forward rather than a V-shaped trend moving forward?
So what I'm hearing is that because the market is moving up, vendors are saying, no, I definitely want to wait until the end of the year to put my property on the market, because now I know I'm going to get a higher price if I wait it out. When it was going down, it was like, oh man, how long is this downturn going to last? What do? I guess I'll just sell it. Now they're really holding off. So I actually think that in the short term, the supply problems are actually going to be exacerbated. And I think all eyes on the spring selling season. V-shape, price wise, we're having a bit of a V-shape, and I think it'll continue for a few more months.
Cool. All right. That's pretty much it, John. Anything else you want to add?
Nope.
All good. All right. Okay. Well, thanks, listeners, for joining us today. Like I said, everything that we touch on today is definitely just general advice, not financial advice. So if you're looking for anything specific, please do check with your accountants, financial planners, mortgage brokers, whoever. But otherwise, have a lovely Easter, and we'll be back again in about 2 weeks' time in that episode of Spark Your Fire. Cheers, John and David. Bye.